Welcome to the Dividend Talk podcast, episode 140. How to decide what to buy when the market is under stress. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. I'm your co-host, Engineer My Freedom, and today I am joined by European DGI. So sit back, relax, and join us as we dive into the world of dividend investing and discover the power of passive income. Happy St. Patrick's Day, European DGI. How are you doing?
You need to actually explain me what this is, St. Patrick's Day, but generally I'm doing very well, of course.
St. Patrick's Day is an Irish bank holiday after our patron saint who got rid of all the snakes out of our country. That's what he's famous for.
Are you telling me there were snakes in Ireland?
Yeah, apparently so. Apparently the island was covered in snakes and St. Patrick came along and banished every single one of them.
Oh wow! Oh wow! Well, history is rich of these kinds of stories, right?
And we have a whole holiday around it now, so it's awesome. But you know, I think it's probably bigger in the US than it is over here in Ireland. Yeah. Yes, we have the parades and we have the celebrations. Most people, including me, spends the day in the pub. But I was watching some of the parades in New York, and boy, they go much bigger and much better than anything we do over here. So it's awesome.
But that's normal with American culture, right? Everything is bigger and more rich in these kinds of things. But you need to like it, of course. I think there's nothing better than a real Guinness and a real Irish pub, right?
Exactly. And today it's the older you get, it's more about there's a horse racing festival that's on called Cheltenham. So the pubs are, packed. You can't get a seat from about 11 o'clock in the morning. People are drinking, placing bets. I was in there about 2 o'clock. I didn't have too many. I tried to support my Diageo shareholders, but I only had one or two. But it's crazy. Every year it just seems to be more and more people going to the pub earlier and drinking lots and lots of Guinness. So.
Well, what other reason do you have in life at the moment, right?
Exactly. But aside from drinking and all that malarkey, what has been in the news this week for you?
So what caught my attention the most was Pfizer. So recently I did a video about how to pick pharma stocks, and Pfizer is currently having 100 billion in sales, right, over 2022. They expect probably around 70 billion in sales for this year because both their COVID vaccine and the COVID medication that they have, Paxlovid, I believe, if I remember correctly the name, they won't be sold so much anymore, right? Because COVID became kind of more a regular flu for many of us. So this drugs is not needed anymore. So there's a large revenue cliff. Still, you could argue, the company's pretty well positioned. They nicely cleaned up the balance sheet with all the money that they got in. But listen up here, and here you need to really tell me. The question now I have is are they squandering the money? Because Pfizer is paying 43 billion for Seagen, and Seagen is trying to really be a pioneer in antibody drugs conjugates, but really to fight cancer, right? They think that this company will contribute more than 10 billion, and they called risk-adjusted revenues in 2030. We know that there's always risk, and until 2030, it's never a flat line up, right? So they're already using their wording very carefully. It would still give you a 4.3 price to sales 7 years out. The company today is making 2.2 billion with a 12% year-over-year growth. So what the company is mentioning is hey, what we did with Pfizer, we have the global reach, we can really speed up their revenues and such and quickly do it. But let's say they are right, and in 7 years from now they are able to make 10 billion. What will be the margin? 40%, so it will be 4 billion. By that time, you're talking still about a 10 PE, 7 years out. So with all this risk in there here. So 43 billion is really a lot of money, really a lot of money if you think about it. And specifically also if you look at the value of Pfizer itself. So it blew me away. This might easily be maybe one of the best acquisitions that Pfizer could ever done, because now they have the balance sheet strength to do it. But oh boy, they're placing a very, very big bet on this company. And yeah, I get a bit the creeps from this one. And I don't own Pfizer. And when I see this, I think like, hallelujah. And I hope management gets it right, because otherwise they will have this on the balance sheet for many, many, many years, because I don't think there will quickly be a COVID again that Pfizer can like cash in on.
Yeah, we're going to see a lot of goodwill on that balance sheet. But I think the problem I have with Pfizer was the management was questionable before.
Yeah, definitely.
Before COVID. Yeah. COVID was a gift. And I mean, COVID was the biggest gift you could ever give to Pfizer. And to their credit, they did very well with capital allocation and cleaned up the balance sheet. They did everything right. But leopards don't change their spots too easily, and I'm not quite sure on this management. And it's something, I don't know. It's like a gut feeling inside of me just saying stay away from Pfizer, and I tend to.
Yeah, I have the same here. I have the same, and also I saw the documentary about Biogen. No, I was and Biogen, this who actually invented the mRNA for the COVID vaccine. And I believe initially Pfizer also didn't really want to do business with them. Only several weeks later there. So it's and I understand there's risk related to it. There was a lot of stress at the time, but I have the same with Pfizer management. And I see 43 billion. I really get the shivers of this. I mean, we've seen what Bayer did with Monsanto. I know it's not a cancer drug, but they even bought a rich portfolio. And yeah, I would have loved to see that they rather use this balance sheet to buy a more established company or something like Apfi did, right? With Allergen, just take a Botox maker and diversify a bit. Although, of course, the company has just been spinning off, was it Viatris and the consumer health? So yeah.
I mean, if they paid half, for this company, you would probably say it's a good deal. Or
yeah, you could. Yeah, at least you could have a conversation about it.
You could argue about it, but 43 sounds like a lot of money. And as I said, I'm not too confident in management of Pfizer, so I would like to pivot from that one. But it's interesting to see how that pans out for them. As you said, it could be awesome, but I just love how they put risk-adjusted revenues. What risk? What have they adjusted there? Tell me more.
Yeah.
Time will tell. What I seen in the news actually was around the rate hikes, which I think was expected. We know that the ECB are trying to curb inflation. It's of particular interest in Ireland at the moment because there's this eviction ban been in place. I think it's been in place for the last 2 years, where it's really hard to evict somebody now. Okay.
And can you explain in simple English what eviction means?
Kicking somebody out of their home. So if you rent my house and you don't pay rent to me, typically I could kick you out.
Yeah.
With the eviction ban, that became so much harder, and that has had knock-on effects because landlords feel like they're being punished. There's building developments not being built because nobody wants to build houses if they can't get a return from them, and so on. So the government here have decided March 31st that is going to stop. But obviously with interest rates now going up, people are starting to worry. Can they afford to pay the rent? Can they afford to pay the mortgage? They expect landlords to increase rents as rates go up. So it's going to be a difficult time here. It's needed. I do feel like it's harsh. Okay, it's harsh on families that can't afford it, but I do feel that it is needed to kickstart the housing economy here in Ireland because it feels a bit stagnant. And there's a bit of a railroads, and I don't think the government are doing enough, but it's definitely testing times in Ireland in relation to rates going up, inflation going up, and people being able to afford the basic needs to live in a house.
Yeah. Yeah, and this is like really local, but if you considered even that they're hiking the rates at the moment while the banks are in trouble because of the rate hikes and the aggressiveness around that, because we know now from the information we received that some of these banks like Silicon Valley Bank, they were buying really long dated bonds, right, at zero interest. So if you then raise the interest rates and the bonds value therefore go down because people expect that kind of equal rate of return, then yeah, the balance sheet on the asset side goes down, right?
Yeah.
And we have seen also now First Republic Bank, now Credit Suisse in trouble, 54 billion bailout, while the Swiss government also made their largest loss in history, I believe, over the last year. So, I mean, I guess it's really hard for an ECB at the moment now understanding what to do, because on one side, it's probably not like 2008 here. But it usually doesn't repeat a crisis, but it might rhyme. Yeah. So the question now is, of course, like, was this really smart to do? I think they might still get away with it, but the banking story, I feel like we're still in the opening scenes of a nice thriller. So yeah.
It feels like there's a lot more to come, and do you know what? I deliberately tuned out of most news this week because I knew most of it was going to be around the banking crisis that was going on in the United States. Obviously, then we had Credit Suisse in Europe, so it's made its way over here. So that's going to soak up a lot of news, and honestly, I like to shut off from the noise when you have something like that, because it can influence some of your decisions.
Yeah.
So
Yeah, definitely.
But I do feel like you, there's a lot more to come, a lot of bailouts happening, and I honestly, I don't envy the job that the ECB have right now. I really don't.
Well, I never envied them because, it's not nice to always have people in front of you that just want to throw rotten tomatoes at you. So, yeah, but I mean, lots of this has been self-inflicted, right? They have had like the issue just we have in Europe is that not every country is the same. So, some countries, they get screwed by low interest rates while they are growing nicely, so the economy gets even more hotter, and other countries, they get screwed if you would raise the interest rates because they have still too much debt on their balance sheet. So we're generally screwed in Europe, and that was already a difficult story, and now with this whole banking stuff on top of it, I mean, it just shows the dysfunction of the European Union and the monetary system that we have. Although I still think it's better than before the Eurozone, let's say, and such, because I do believe that I do believe in the power of the European Union, and what it was also created for in the end is like, to avoid wars and these kinds of things. So yeah, we can be hating each other, but the good thing is now we're in the same boat. So whether we like it or not, we also need to solve it together, and that's a big difference, right?
Yeah. We're all screwed. We're all screwed.
Yeah, exactly. not just one or two countries, but everyone is screwed. So
okay, so dividend updates. We've had some mixed reviews in Europe this week, haven't we?
Yeah. So first of all, Inditex, the owner of Zara shop. I don't know if it's also in America, Zara, but of course in Europe, everyone knows Zara, right? Yeah. It's where you get your cheap clothes. You still look good when you go to work. Nobody wants to pay too much for their work clothes because, it's work. You want to pay quality clothes for your wife. Yeah, but then you don't need so many of them. So that's why we all go to Zara. They raised their dividend by 29% to €1.20 per share. What is important to mention here is that it's a split between an ordinary dividend of around 80 cents and a bonus dividend around 40 cents. So while this 29% sounds really nice, they particularly mention a bonus dividend. Also, of course, I believe in 2020, they didn't pay out any dividends. It's not a stable dividend grower, but I know that many people in our community like this stock because I believe that pre-COVID, it was quite a decent dividend grower. I don't own it for that reason. Too much stability. I also believe in the retail like this one of clothes and such. I think it's really difficult doing business. But of course, they are a tier one company here. They are excellent. I once studied like this company as a kind of a case at business school long time ago, and their supply chain power and how they reshifted the way we approach fashion. Yeah, like effectively buy throwaway clothes, like for just 2-3 months, cheap stuff, but it looks nice, instead of needing to buy high quality that you need to wear for a few years. I mean, that's just brilliant what this company has done, and the quality is all over there. And I believe that's their mode. Almost nobody can do this in Europe, what they are doing, and still be so profitable. Yeah, but just I don't trust their dividend growth track record so much to invest in it.
Yeah, they are a company I know, as you said, a lot of people like. Phil actually was on this show before. One of our earlier podcasts wrote an article on my blog at the time, Engineer My Freedom, about this company, and it is really, really interesting. And I think they have a unique marketing strategy as well compared to
Oh, definitely.
all other companies, which seems to work quite well. As you said, it's a great brand. Everybody knows Zara, and I think they are prone to cutting their dividend, but I think long term they do try and grow that dividend. So it is a slow, how would you say, a compounder over time. But if you want stability and don't want to have the dividend cut when times get tough, it's hard to own this company. And like you, I struggle with that, particularly in this segment where it's not a necessity, it's a luxury. And I feel like in the current market and the way things are going, people don't want to be shopping in Zara. They might want to shop in maybe a less.
I don't
Primark.
really still agree with it, because I think Zara is still really affordable, like H&M. And we need to give the company also a little bit of slack, because come on, in COVID the shops were effectively closed for a few months. So it shouldn't be surprised that such kind of retailers that really depend a lot still on in-store buying, that they had a tough time and had to be really cautious cutting the dividend. But their online business is also really good. I mean, I see my wife and I see others as well, how at work at times, how they are buying stuff and such. And this company is there to stay. It's iconic brand, I think. But yeah, the dividend stays questionable still from that point of view, as you mentioned. Yeah. Anyway, we have a new aristocrat, because WP Carey hiked its dividend really meagerly by a 0.2%, but to $1 and 6.7 cents per quarter. So annualized, they will pay now 4.27 dividends per share, and 25 years of consecutive dividend growth. So congrats to all the WPC ticker owners. I think it's always nice when a company reaches aristocrat stage, right?
Yeah, I mean, they are a dividend aristocrat, but if you are looking for dividend growth, they're not great at growing their dividend. Typically, you see 1% over the last 5 years, but they do have a high starting yield of around 5 or 6%, I think.
Exactly, yeah.
So, but it's a company I own. As you said, it's a stable company. It's in the real estate business as well. So, congratulations to WP Carey and welcome to the aristocrat status.
Yeah, and then let's talk about another real estate company, because our friends from Germany, Vonovia, they have actually cut their dividend, and the board of directors is proposing a dividend of 0.85 cents per share for 2022. And I really love the narrative around it. Vonovia's business model is intact. Boom, lots of self-confidence, always management. I think sometimes CEOs are really like psychopaths, right? Really awkward people.
I think if they say it into existence, they feel like it's real. So they just keep repeating it.
Exactly. Yeah. So what they're saying is they are expecting to see really robust developments on the earnings side. However, they need to find the right balance between two different expectations among our shareholders. Of course, blame the shareholders, right? It's always the shareholders. So one group of shareholders would like to see continuity in their dividends, while others are calling for special capital discipline. Both are equally important, of course. And that's why I said it's prerogative. I actually don't even... Do you know what it means in English? Prerogative?
No, I
okay, you know when they use difficult words that they're trying to fool you.
I do know, yeah. It is the prerogative. So it is the... How would you say it? Prerogatives of... It is the goal of the shareholders.
Okay, of our shareholders to decide on the dividend. And so we are convinced that our proposal is reasonable. I mean, what a bollocks, right? What a bollocks.
So, like, that statement alone, for me, symbols what Vonovia is all about. And part of the reason why I sold them is I find them really, really hard to understand. Their business model, to understand what they're doing. And this just typifies that for me. Even what they're saying there, it's hard to make sense of what they're actually saying there. They're blaming the shareholders. They want to pay dividends, but they want to allocate their capital better. I mean, come on.
Yeah, they're effectively saying that we as shareholders don't make up our minds what we actually want. So then, you know, unfortunately, the board of directors has to decide for us. What an idiots. What an idiots. What an idiots.
Yeah, I mean, it's a company I'm glad that I'm not involved in anymore. Honestly, it's too hard. I put them in the too hard bucket, and they're definitely staying there for a long time. Awesome. So we spoke in the news of the week. We're talking about turmoil in the markets, and we can see that. I tuned out of the news pretty much all week. But a question I had on my mind is, how do you know what to buy when the market is under stress? I think you made, it was a tweet or something. It's like a candy store. Lots of people have been saying that. But how do you know what do you actually buy? There's lots of articles in Seagen Alpha, Investopedia, giving all sorts of recommendations. And if you were to follow them, I know there was a popular REIT there recently. Is it MPW? That was being touted around, and now they are in trouble. So it's hard to follow what's online. So how do you decide?
One thing I learned just by living through 2007 and 2008 and 2009 is to always avoid the blast zone. I know, and I saw it on Facebook as well, some people are looking now at banks. They think like, you know, guys, this bank is probably a good bank. They get pulled down, so let's buy it. I remember back in 2008 sitting in the classroom where people were all massively asking the professor, like, should we buy ING at 10 euro? Yeah, ING at 10 euro. That was all the time the question, because it was like in the early summer of 2008. You need to know that in, I believe in October, November 2008, this full stock market crashed. And Bernstein's, I believe, was the first one, December 2007, getting into trouble. So you saw over like 9 to 10 months as a continuous set of events happening around banks. Yeah, and this is kind of where I say it rhymes. Yeah, we have now already 3 or 4 banks that are in trouble. So I hear now when I hear people saying like, maybe this bank, I don't know, for instance, JP Morgan or something like that and such. But honestly, guys, stay away from the blast zone. That's what I've learned, because ING was before the summer, let's say June in 2008, trading at 10 euro. And I know that many of my classmates were buying at the time. Yeah. Half a year later, they were trading around 2.5 euro when shit really hit the fan in the stock market. Because, you know, if this is really still around banks, that their assets are not so strong and they really get into trouble with their bond portfolio, you don't want to be in this space. Yeah, and you don't need to be a hero. So in my opinion, rule number 1 that I apply here, stay away from the blast zone, even if it really, really looks tempting.
Yeah, I agree with that. And I feel like if you are not watching the banks, so you don't understand the banking sector 100% prior to this happening, it's probably too late to start looking at it as soon as the crisis starts, because we don't know how long that crisis is going to last for. And all the information you're going to be reading now is probably going to be skewed, in my opinion. So I 100% agree. When I see this banking crisis, the first thing I think is I'm staying the hell away from banks. I can't even look. It's too risky. It's far too risky for me at the moment. But that's part of what I do first, is I just try and block out all the noise. You hear me say that at the start. I haven't gone online, haven't gone on to Twitter, because everything is about these banks at the minute, and I mean, we're only human, and the more you read about it, the more you get absorbed into it, and the more it will influence my decisions. So that's the number one rule I do, is I'm only looking at what's in my portfolio right now, nothing outside of that, because I just want to stay away from all the noise. What's in my portfolio, I know. What's outside of my portfolio, I don't want to be influenced in the current market.
Yeah. So for what is to the point that you make, right? You mentioned only in your own portfolio. You know, I also have my kind of a watch list, or the top 40 stocks that I want, or top 50 it is by now. So I also look into that. But the issue is now actually that high quality stocks that are not in the banking sector or financial sector are not really being impacted at the moment. Yeah. So Texas Instruments, $177 or something like that. Louis Vuitton, still around €775. I mean, hardly a blink the stock is giving. So, you know, even ASML is still in the high 500s. So that's the issue, right? It's really at the moment contained in the financial services sector. Insurance companies are really nicely going down. And this is very interesting, because you could argue that they are not in the blast zone. Yeah, and that's why they're interesting. And I really am eyeing the insurance stocks. But I would like to only raise one word of caution here. Please remember that many insurance companies are heavily investing in corporate bonds and such. Yeah, so it's one way for them to kind of make a buck on the float that they have. I don't know how much those insurance companies are again exposed to banks, and whether they also have their bonds stored at a bank if they don't have their own banking facility. So while I do believe that insurance stocks itself are not in the blast zone, I would keep an eye on it, and therefore also I would try to, you know, warn people from buying too aggressively in insurance stocks, because you might be really catching a falling knife, and maybe these stocks are going down for the right reason, because their investment portfolio is not so strong as it was. Yeah.
There's definitely inherent risk, particularly, as you said, insurance companies. Asset management as well is another one. T. Rowe Price, which is one we speak a lot about as well. So there's a lot of risk, particularly in the financial services sector, as you said. And I would definitely, honestly, I would only stick to the ones that you truly know and understand. And to your point, make sure you understand what percentage they have of their balance sheet or their cash in the bond markets, because I think that's, as we can see, that's a really tough spot to be in at the moment.
Yeah. So what leaves up then, right? I mean, consumer staples, always good in terms of recession and crisis. Then we have the pharma. It's typically anti-pattern, right?
Yeah.
As long as people are dying and getting sick, and they have the drugs to cure it, or to extend people's life, you're kind of good with pharma. So for me, those are typical sectors that I would go to. And also the energy sector is really tricky, because we see now oil is also collapsing at the moment. Yeah, maybe collapsing is even too big of a word, but Shell is now around €25. Quite a rapid decline lately. And here again, right, what often happens when people get scared, let's say, and they start thinking like, okay, now really recession is coming, energy gets hit, oil and gas, because they think like, okay, the economy might slow down, less need for oil. So the oil price starts to really early respond already to this kind of stuff. So also that's a sector where you don't necessarily need to be a hero in the beginning. The good thing is, anyway, oil was already on the high end of what we might logically expect. So so that doesn't give too many sectors at the moment, right? When you think about that. But there's also really this thing, and we discussed about this before on the show. Watch out, guys, with being too aggressive in the market. Please stick to your roles. If you're really doing dollar cost averaging, and let's say you have €1,000 to spend every month in the market, then you have only €1,000 to spend in the market. I would really recommend to not go into margin, not bring your 2,000 or 3,000 forward thinking this is it. We don't have a crystal ball. And if you're doing that, you're actually timing the market. And I really want to call this out because we often speak about this. And these are these moments that if you're going really aggressive and pulling money forward or something like that, you are timing the market. Nothing wrong with that, as long as you realize that you're doing this so that later you're not surprised and that you feel like, oh, I was too aggressive and I should have waited.
That's a good point, because we actually got a question around that, and I'll raise the question now, and it's from John, and he asked us, do you think that sticking rigidly to a chosen strategy limits your options that might sit outside the strategy? And I think what you said answers that absolutely perfect. I mean, you're only asking that question now because of what's going on, and you want to maybe invest in the financial markets because you think there's opportunity there. But you had a strategy for a reason. Why do you want to change that now? That's the key question. Why are you changing it? Are you changing that purely based on greed and you think it's easy money? Or are you changing that because you're an expert in this area and you feel like that there's an opportunity? So for me, I would have to agree with European DJI. If you had a plan, you had it for a reason. That's
Yeah, and we are kind of DCA kind of investors, right? With dividend growth investing. We had Cameron Stewart one time on the show here, and he mentioned like, okay, at the time he said if Facebook was at 100, he went to the bank and asked for 25K or more to buy as much Meta as he could, right?
Yeah.
But then you're a value investor, and that's fine. Yeah. What I've also learned is every time I go off track from my strategy, I'm not doing well. Yeah, and these are kind of the learnings. So we have one guy called Drip in the Twitter group, and he's always say, stick to dividends, boys and girls. Watch out with your turnaround. Stick to dividends, boys and girls. And I think this is also what really applies here. Stick to dividends, everyone.
Yeah, and it was one of my biggest learnings that from 2022, and I deviated into all sorts of different strategies and options and so on, which is well documented. And I always felt it was a distraction. And this year I am determined to stick to my strategy, and I'm certainly not going to get involved in anything that's going on. But as you said, that only leaves us with a couple of different sectors. And I was saying, okay, it feels like a candy store, but block out the noise. Focus what's on your portfolio. But better still, maybe focus more on your core holdings, and particularly around utilities is probably one, pharma stocks, and consumer staples. I think they're the three that I'm probably going to focus on. I'm not putting in any extra money. I have money waiting in the side, but I still don't feel like the market has capitulated enough to say that it's a full-blown crash. I still think we have a bit to go here.
Yeah, I think as well. Outside of the banking issues, you could say, like investen nichts Neues. Yeah. Here. So what I said, I mean, we did last show about some of the stocks, right? So for me, Johnson & Johnson, a really good example. Nationale-Nederlanden, auto and insurance dropping quite fast. If you really don't own insurance stocks and you want to do an entry position, I think, at an 8% yield, relatively safe dividend, in my opinion. I mean, two good stocks, right? For now.
Yeah. I'll be more looking at Ahold Delhaize as well. They're starting to look more appealing in this kind of market. But one other advice I would give to people, and that is try and forget about the price and the yield. Because I think particularly in this market, particularly in these conditions, you're looking at banks, you're probably looking at the yield on some of these. And I know Chuck on our Facebook group, I think it was our first retired member, but he had given a pretty good description of one of the banks that he invested in. It was dropping in price. I can't remember the prices he picked it up at, but he picked it up at a historically low price, and it dropped another like 60% and then rebounded like a day or two later. But it just shows the volatility, doesn't it, in that sector. And it looks like he understands that sector because he's invested in banks long before any of this, and he knows a lot about banks. But it just seems absolutely crazy. So I would say try and forget about the yield, forget about the price, focus purely on fundamentals and what can change them.
Yes. I'm surprised that Chuck is still with us after all my insults to bankers over the last 3 years. but guys, if you actually want to see this kind of stuff, right? Let me plug really quickly also the Facebook group that we have. So we have a Dividend Talk Facebook group. You can probably find it if you use the search function on Facebook. But out of courtesy, we'll also put it in the description of this podcast. So feel free to join. You have to answer 2 questions more to keep the spammers outside. So hope to see you there if you didn't join yet.
Cool. So look, I think the key takeaways from here is try not get too greedy, stick to your core holdings, and focus on fundamentals and stay away from all the noise. I think that's the key takeaway. But we might jump on to some listeners' questions now and see what kind of fun questions we have today. Tiago has asked us, ticker symbol WU is looking very cheap. Would you buy a declining company if it was cheap enough?
Yeah, so I believe this is Western Union, right?
Yes,
in Europe, really used for transferring money. I mean, for me, this transferring money is what our parents did via Western Union. Yeah, nowadays you have all these online services which makes it much more easier. So the question here is really about, do you follow Warren Buffett's approach of buying a cigar butt? It needs to be really, really special to consider it. But you know, there's so many other attractive stuff out there. I really want to focus on high quality companies with lots of growth. I think such things are maybe nice from kind of a value investment point of view, but I'm first of all, I'm a dividend growth investor with a value investing mindset. And if it's really a dividend, I said declining business, I don't believe that dividend growth is really safe. And I've burned my hands on Tupperware in the past, so it smells a little bit the same here. Although I have not studied Western Union to give a really solid recommendation on this.
Yeah, I mean, declining and cheap together is very, very hard to find. It's declining for a reason, so maybe it's not so cheap. But honestly, I don't feel like I'm skilled enough to know, because you really have to be sure that this company, like we talk about turnaround place, but I don't feel like they're declining companies. I don't feel like Intel overall is a declining company in huge trouble. They're a turnaround, they're in a little bit of trouble, but I don't feel like I'd be skilled enough to decide when that company is cheap enough to buy and that it will turn around. I mean, Warren Buffett can do it maybe, but I don't think I'm skilled enough to pick them. So no, I would typically try and stay away from that scenario.
Fun fact, by the way, I know we shouldn't speak about stock prices, but Intel's 20% up since 1 or 2 weeks ago. So talking about the crisis and not being in the blast zone. What a stock performance.
Has there been news? Has there been something?
I no, not generally, but you see sometime, I mean, more and more you hear some reviews that these new chips are actually quite performing. So maybe some people see some light in the tunnel finally. And I hope these are not the headlights of a big train coming in. But yeah.
I just want to say you're welcome, because I did sell them, and that's probably what drove the price up. Okay, Martin has asked us, have you ever checked out Gerbet, ticker symbol GEBN? Interested?
Yes, definitely. I sometimes sit on them and bring my kids to the pool.
So they make toilet. I did not know this until this question came in, but they make toilets and sanitary products, don't they, from Switzerland, I believe?
Yeah, I'm not sure if they are from Switzerland, but I know they're everywhere in the shops here, Gerbet. And actually, I looked at them some time ago, Mate, maybe 1.5 years ago. So first of all, I really, really generally think that these are high quality products. Yeah, they have a certain brand that is good. It's sticky, and I believe if you go to someone's house, at least I can say here in Eastern Europe, and as Geberit, you know that these people have invested decently in their sanitary stuff. But I just remember that I was not totally convinced about this business also as a stock, and I don't know anymore the exact details, Martin. I would need to look up whether I have still some notes somewhere. Yeah, maybe I should look at it again. So Martin, if there's anything that you feel like is interested about this that should deserve my time out of all the other stocks that I have also on my plate, then just drop me a note and I'll have a look at it again.
Yeah, what's interesting to me is they sell their products to wholesalers, plumbers, architects, and engineers. And to me, and looking at the growth over the last 10 years, it looks like it's a steadily, slow but steady growing business across revenue, across EBITDA, across cash flow. So it looks like they're doing quite well. So for me, that screams, okay, they have a strong brand name. I am an electrician by trade, and I do know that we are a sticky bunch, as you said. We tend to stick with brand names. So you'll see MK switches or Nipex, and we tend to stick, if there's quality, you tend to stick to them. And I feel like it would be the same for plumbers and architects and wholesalers in this case as well. So from a brand perspective, I would have no issue. I've genuinely never looked into them before, but it does look interesting. The only thing for me, as I said, it's on the Swiss exchange, and that high tax rate is a killer. I did have somebody reach out to me today and say, "Hey, why do you keep beating down on these? You do know you can claim that back?" And I know you can, but the amounts are probably too small to be worth my while. That's the problem.
Yeah.
But yeah, no, it definitely looks like an interesting business. If you're looking at a total return over the last 3 years, it's 10.7%, and actually over the last 10 years, it's actually also 10.6. So it seems quite consistent. It's
That's a nice compounder,
steady growing compounder. So it definitely looks interesting. Based on the dividend tax, the dividend yield of 2.5 is too low for me to give them any of my time.
Yeah. Okay.
Div Collector, this is a good question considering what we're talking about. So he's getting super greedy with insurance companies like NN and ASR at these valuations. He loaded up last week. The positions are becoming relatively big though. My dilemma: take benefit from the opportunity or stay disciplined. Your thoughts?
Stay disciplined. Sometimes you might feel like we had at the time with Royal Dutch Shell that we knew that this, when the oil was under zero, your gut feel all tells it. But for me, we just mentioned, like, it feels like we're still in the early days from this. If something really has to happen, and don't worry about later feeling like, I should have done it. Staying disciplined will pay off in the long run. And yeah.
If you have to ask this question, it means you have doubts. And if you have doubts, it might work. It might work out good, and it might not. But just think about what would happen if it didn't work out good, and that might sway your decision a little bit.
Yeah, I do believe that for both the dividend is safe. Yeah, when we talk about Nationale-Nederlanden and ASR, I see no reason why they would need to cut the dividend. If you both look at their balance sheet and such, ASR just acquire Aegon, so it's a bit. I'm a bit curious to look at how the balance sheets will look after that.
Yeah,
but generally, I think it won't hurt. But if you already bought a lot, why don't you diversify a little bit in your buying spree? T. Rowe Price, G&G, there are quite some other companies still at attractive valuations.
Yeah. Future dividends. Do you make buy and sell decisions based on currency? As a US investor, it is increasingly frustrating to see dividends growing in foreign currency, but actually cutting in USD.
No. I'm let's say a little bit more than half of my portfolio is in American dollars, and I still am price anchored around 140 from the good old days early in 2014 or something like that, and we're now around $1.05. So I mean, I don't know what the dollar euro will be tomorrow. So If I don't know, I just keep dollar cost averaging every month. Because we spoke about this in past podcasts when it was at parity. Well, maybe it will be 0.90 2 weeks later, right?
Yeah,
You don't
yeah.
know.
Yeah.
So, and generally, I wish we would have a global currency. We don't trade in bitcoins on the stock market. We don't buy in bitcoins our shares. Yeah, if there would be a global currency and no Polish zloty anymore, of course, that would be ideal. But reality is different. And if future dividends really has this problem as a USA investor, then maybe consider just not investing in other countries if you really depend on the dividend income.
I can see where he's coming from. When I buy my portfolio, I have European stocks, which includes Great Britain and USA stocks, and I look at the dividend income in those currencies. I believe, and looking at the question, future dividends will buy ADRs, which will be European companies or other companies that are listed on the stock exchange as well. And I do write for sure dividend, and I can see this because I cover a lot of ADRs that are European actually, and I'm talking about how great their dividend growth is. But then when I actually convert them across, it looks like they've cut their dividends 3 and 4 times. So I can understand why that's frustrating, and it's a different kind of mindset. But like you, if that's an issue, technically the company are not cutting their dividend, but you are getting a dividend cut. So it's probably best not to
But it happens to me as well. My dividend portfolio, I track everything in euros. So I know what my projected annual dividend income in euros is. But if I wake up tomorrow morning, depending on the currency fluctuations, it differs a bit. Yeah. And sometimes it's actually quite a lot, because if it goes up 2% or something like that, the currency, you directly see that in quite some money in you. But it's just, I treat this as one of these things. It's like, it's life.
Yeah.
It's life. Yeah.
I track in euros overall, but I do also track each company individual based on their currency growth. I don't consider it a cut, even if it's a cut in euro, because I track it in their local.
No, the tracking I do in the native local currency. Yeah, because that's really what shows if they are growing the dividend, because we want to see whether management is committed.
Yeah, but future dividends will have a different problem, because he's going to track it in the ADR currency, which will be
exactly,
and it's going to be a cut. So I know, I understand the question. Dividends by Potter. A stock you want to own, but its yield is too high for you to be comfortable buying it. Petrobras was one of his.
Look, if the dividend is high, let's say 20%. Let's take something really absurd, 20%. But for instance, the payout ratio is 30%. Why not? The issue is if it's at such a situation and yield, it's probably trading at a 1 PE or something like that. Usually, in the current market, that is a sign that they declare this company bankrupt for whatever reason. So for me, typically anything above 8 or 9%, and if it anything, let's say towards 10% for me is like probably too hot to touch, rings all the alarm bells, and it needs to be really a high exception that I would consider it. And then Group has 8% now. I think it's decent. But for instance, Omega Healthcare, which I also own, that was often touching 10%, right? But I owned it already, so it was not for me a reason to sell. But yeah, 10% for me is really this kind of psychological barrier to invest. All alarm bells are ringing there.
Yeah. It's a hard question. I don't know the answer of one that I want to own that the yield is too high. Most of the companies I'm looking at right now, I suppose TROW Price is one, NN Group is another, and then I hold none of them are yield is too high at the moment. So it's a
but look, a 10% dividend. Yeah, imagine that it's a full payout, like 100% of the earnings are paid out. It means you're talking about 10 earnings yield. That means a PE of 10. If this 10% yield is, for instance, then on 80%, you're probably talking around a PE of, let's say, 8. Yeah. If you're talking about a regular business here, while the S&P 500 is trading usually around 15 or something, and this company used to be there as well, you're often talking about a stock with a story, a turnaround, a broken stock, or something like that.
Yeah.
Yeah.
Look, someone like Walgreens is probably up there, I would imagine. I don't know what their yield is, but I think it's quite high for that reason.
Yeah.
Alexandros has asked us the biggest bargains in the stock market today, in your opinion.
Yeah, I think NN Group, I mentioned a few times, is probably the biggest bargain at the moment, although I'm also cautioned around that, as I mentioned.
Yeah, see, it's hard for me to answer that because as I said, I'm focusing within my portfolio. I'm not taking account of anything outside of that. So I'm really niched down. So I can't give that answer without being too biased, unfortunately.
Yeah, but come on, we are not this kind of show. You need to give a name.
Yeah, well, I've mentioned I'm buying NN Group and T. Rowe Price and Ahold Delhaize. They're the three that I'm buying, without question. That's
good. Thank you. We respect our listeners and we answer their questions.
There is one other company I'm going to look at actually, which is Enel, the Italian utility, the electrical utility as well. But I need to do my research on that company first.
Yeah.
Marek, how much money do you keep prepared for? I love this, promotion days.
Yeah, at the moment nothing anymore. For a really long time I had a war chest. I still have some money on the sidelines, but I'm not using this money as lump sum. What I've just did with that money, because I get also a bonus from time to time. So I look at all of that and I spend more every month than I could afford, let's say, from my monthly income, because I take the bonus as well that I get in such in the year and I spread that out over 12 months. So hence, technically you could say I've got money on the sidelines, but realistically, I'm not bringing it forward. I just spread it out because I want to buy every month in the same volume, and yeah.
Yeah. I try and invest the same amount every single month as well. I do have a little extra sitting around, but I typically don't like to spend it all at once either. I will drip it in if I feel like something is really undervalued. Like I'm looking, as I said, at the two companies I've mentioned about 10 times in the show, but I'm looking at these and part of me wants to bring them up to par with some of the other companies I have in my portfolio. So I don't have a percentage there, but I do have money aside just in case as well. So and the last question, I love this one from Manny Mystery, and on the back of your excellent, I must say, video on pharma stocks, how sinful do you consider big pharma?
Well, I think it's even like also tobacco and such. Like, so how do you actually draw a line between what is ethical, a good investment or not? So simply, we're living in a capitalistic world. I don't believe in this stuff. I have yet to find a company for a woke index, that is purely like woke, how you say it, compliant. I don't know any company, even Unilever, which I think is kind of trying to be a front runner in all of this, is still using a lot of plastic, is still using all these kinds of things. And we know that fish are full of plastic. So this makes it really hard. What in reality, my sin stock definition is defined by my wife. She told me you may not buy tobacco. I could own anything except banks and I said companies that are selling guns or weapons. Yeah. So I don't want to have stocks like General Dynamics or something like in my portfolio. For a really brief moment, I owned UTX, but then they merged with this other company and I sold it. Here with Raytheon, I believe. So so for me, but I think this is really personal. That's how I look at sin stocks. For me, everything is a sin stock by definition, because pharma, you can talk about the nice one, as you say, they're saving people's life. The bad thing is like They are not really giving access to everyone in the world, high drug prices, this kind of stuff. Oil, you can say they are uniting families. Yeah, because of your car, you can go to your family like down the road, right? Few kilometers down the road. And how great is this that the company enables you to do this? Yeah. So, but at the same time, you could argue like, whoa, the whole Niger Delta in Nigeria is fully polluted. Yeah. Tobacco, we know it can kill someone, but on the other end, I mean, great stories and great networking happens outside the office, in front of the door where people are smoking. That's where many people can build their careers, right? Mining, they build the minerals. They really allow us to produce phones, and you can connect your grandmother on the other side of the world via WhatsApp and video calling. Yeah, at the same time, yeah, you understand? Think about consumer staples and think about the supermarkets like Ahold. They sell you avocado for €1.5, €2.5 per piece, all the way shipped from the other side of the world. I mean, come on. Yeah, well, bankers, yeah, but on the other side, it enables paying that, we do business all together. So tell me, what the hell is this in stock? I only believe there's no stock that belongs in a woke index.
Yeah, I mean, I actually quite enjoyed you playing both sides there at the same time. But I feel by normal definition, the way people look at it, you have, as you said, weapons and tobacco. They are proven to kill people. And you could argue that there is stuff in pharma that is not quite ethical and has caused deaths as well. So I can see the argument there.
Okay, but then you put it on the line of killing people.
But you're putting the whole sector into the same bracket as maybe one or two companies, because the whole pharma sector is not just about drugs that cure people. You can have companies that make medical devices and stuff for your legs and for your eyes, or stuff that can't kill you but can help you.
Well, we have seen what Philips did with their devices, right? I mean, for me, it is really what your value system comes down to, because you're just talking about killing people. You could also talk about creating poverty.
Yes.
Yeah. There are many companies that create poverty all around the world by taking all the resources out and selling it somewhere else for the cheap. You can also talk about child labor. Yeah. So it really comes down to your own value system, I believe, and that's why I'm saying no to banks, and my wife is saying no to tobacco, and that's why we don't own them in our portfolio.
It'd be it's a good question, isn't it? It would be a good debate from somebody on both sides of the fence. But for me, I don't have any values. I invest where I can make money. I invest in tobacco. I invest in war ones, and I invest in pharma.
You're the classical right wing rich guy, white rich guy that is.
Show me the money.
But then you probably vote left wings on a Green Party or something like that.
Yeah.
Yeah, nice one.
Awesome. Thanks to everyone for all the questions. As always, if you've stuck with us this long, we really appreciate every single one of you, and hopefully we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.